The dollar is soaring, global bond markets are imploding, and commodities, which were at one point the high flyers of 2022, well, they're now rolling over in dramatic fashion too. But perhaps even more worrying than that, correlations between asset classes are rising, which may mean that people are starting to sell not what they want to, but what they can. And that's typically a sign that things are becoming unstable. Frankly, stress has been building ever since Jerome Powell's infamous speech at Jackson Hole a month ago. But the question we need to ask ourselves is, have we finally reached the breaking point? Because that's this week's big conversation. There's no question that it's been one hell of a week in financial markets. Just look at some of the currency moves we've had between the Japanese yen and the British pound. Last Friday, the British pound fell almost 3.6% in a single session. It's almost a daily occurrence where at least one developed market currency is falling anywhere between 1% and 3% against the US dollar. And to be clear, that is not normal. Now, what's crucial during a time like this is to make sure you don't lose your shirt, which would then affect your ability to go on the attack when opportunity comes knocking. Stay patient, watch, listen to the events that are unfolding around us. So, let's take a look across the financial system and see what's going on and what matters most. I assume most people watching, especially in the US, care most about equity markets. And yes, they are sitting right around year-to-date lows. Many of you will see that as cause for alarm. And yes, of course, it's a reflection of the challenges facing corporations during these highly uncertain times. Having said that, believe it or not, equities are acting rather resilient when compared to the fixed income or some of the developments in currency markets. What's the scoop here? Well, in normal times, the resilience in equities would make sense when you look at things like the ISM Manufacturing Survey. You see, the ISM tends to have a decent track record as a leading indicator, so the fact that it just posted its 27th consecutive month above 50, which is the threshold that separates expansion and contraction, could be viewed as reason for optimism. Offsetting that optimism, though, are other indicators like consumer sentiment and various investor surveys, and they show an alarming level of negativity. Right now, the AAII survey shows the fewest number of responses as bullish since April of this year. Okay, yes, I'm being a tad facetious, but seriously, the readings this year have far surpassed the depths of the global financial crisis. In other words, people are saying they are downright terrified. Now for some good news. Sentiment surveys tend to act as an excellent contrarian indicator. When people expect the world to end, it's not all that difficult for future developments to seem, let's just say, not so dire. But this brings me to another point worth exploring. Judge a person not by what they say, but by what they do. And have we seen major retail outflows yet? Not really. According to FactSet, US ETFs have drawn in $332 billion through the first half of this year and have exceeded full-year flows for every year between 1993 and 2016. We can also look at the drastic diversion between AAII's own data. If we look at the survey data, investors say they're extremely bearish. But if we look at the asset allocation data, investors still hold equity allocations above the long-term average. So why are investors so calm in an otherwise terrifying world? Well, as we just mentioned, some leading economic indicators like the ISM aren't all that troubling. And secondly, employment, which is such a crucial pawn in all of this. It's still not crumbling despite corporate commentaries of impending layoffs. So yes, equities haven't been all that stellar year to date, but really, we haven't seen a big puke or true panic. So when will that happen, I hear you ask? Well, a lot depends on unemployment. You see, major equity drawdowns don't typically occur until we see a meaningful rise in the unemployment rate. Will we see a dramatic rise in the number of unemployed persons here in the United States? Well, that's a big question. But for those of us watching and listening for the clues, we should be monitoring initial jobless claims, which is a higher frequency data series and tends to give an excellent lead for the headline unemployment rate. So there are reasons to be optimistic and there are reasons to be more cautious. But again, all of this is predicated on normal times. And as I said right at the outset, what we've seen the past couple of weeks is certainly not normal. Following the Federal Reserve's decision to raise the Fed funds rate by 75 basis points, the Bank of Japan walked, in fact, ran in the opposite direction. Not only did they not raise interest rates, leaving their benchmark rate in negative territory, but the central bank reiterated its commitment to yield curve control. And with the rest of the world firmly in tightening mode, this divergent policy stance has sent the yen tumbling, forcing Japan's Ministry of Finance to step in with its first direct forex intervention since the late 1990s. Now, some suggest this temporary maneuver won't be effective because the BOJ is still running full steam ahead with its QE program. But therein lies the issues facing many central banks around the globe. As the Federal Reserve pushes interest rates higher here in the United States, those yields become more attractive to foreign investors. Foreign investors pour capital into the United States to capture the higher rates, creating upward pressure on the US dollar and downward pressure on their local currencies. And a depreciating currency tends to fuel further inflationary concerns and thus even more capital outflows, and the cycle repeats. In the case of Japan, this circular reference where global rates are surging only creates further headaches for the Bank of Japan. As capital flows out of the Japanese government debt stuck at zero, it only makes things more difficult for the BOJ that now needs to buy more debt in order to maintain current yields. So, what will they do? Continue with QE in the face of rising rates and risk a disorderly decline in the yen, or abandon existing yield targets? Well, in the case of the latter, surging Japanese yields that serve as the basis for many carry trades is certainly one of the many lurking tail risks across the global landscape. And then there's the situation over in the UK, where the pound has come under significant pressure this year, not only due to surging inflation, but the lack of an aggressive policy response to it from the Bank of England. To combat the rising cost of living, the Conservative Party recently announced a fresh round of stimulus efforts. However, much like the initial COVID response, deficit spending is often viewed as inflationary, and in response, the pound fell precipitously while UK government bonds, popularly referred to as gilts, also tumbled. Again, we can think of this in terms of that circular dollar reference where investors flee a weakening currency, accelerating the decline, which only exacerbates inflationary pressures. Now, naturally, all eyes have turned to the BOE. That's right. If it hasn't happened already by the time this show airs, watch out for the Bank of England hiking rates in an effort to stabilise the pound. The point in all of this isn't to scare investors, it's to highlight the many tail risks lurking in the weeds. And while the current narrative around bearish sentiments is catching all the headlines, positioning data suggests equities could be at risk of a larger unwind. Between the dislocations in the bond and foreign exchange markets, as well as the Fed's stated mandate to fight inflation by slowing demand, likely through a rise in the unemployment rate, there are a lot of headwinds facing equity investors today. And keep your eye on correlations too. The higher the correlation, the more the panic is inferred. Markets are volatile, and many are wondering when and if we may see real breakdowns in these markets. To help answer this question, Real Vision's Roger Hirst sat down with Kokou Agbo-Bloua, Head of Economics, Cross-Asset Quant Research at Societe Generale.
Kokou, great to see you. And today I'd love to sort of pick your brains about, I guess, sequencing, because we've obviously gone through this soft patch already, but people are really thinking about, okay, do we get a real recession and what does that look like? But before we go on to that, what I just want to sort of get my head around really is that we've seen a historical move in most bond markets, quite an astonishing move. And although we've seen a fairly big move down in equity markets, in some ways, equity markets have been relatively resilient considering the size of the move of the bond market. I mean, are you surprised at how resilient equities are? And why do you think that equities and bonds, although they've gone down together, the bond market move have been so much more incredible versus what we've seen in equities?
Yes, thanks, Roger, and thanks for having me. This is actually a very interesting question because I think people remember the crash or the equity bond correlation debacle in December of 2018, where you had the Fed hiking rates and leading to a significant collapse in equities. I think this time around we have an inflation shock or inflation super spreader event. And bonds are obviously nominal assets. And as central banks need to fight this inflation virus by raising rates, they bring down the price of bonds and push yield higher. However, equities have this interesting ability to pass inflation or cost push inflation, which is the problem we're dealing with the energy crisis, through pricing power. So some equities with pricing powers have been able to raise their prices and essentially protect their margin. And we call this greedflation. In other words, by being in a position of power, some of them have abused that position of power by raising prices by more than what their input costs have increased by. Clearly, this might not be sustainable because ultimately demand destruction occurs, volume start to fall, and then profit margins start to fall. But for now, we are in this sort of tipping point where earnings are being resilient because companies are able to pass on that prices, and the increase in price is higher than the drop in volume, depending on sectors, obviously.
So timing is everything, and therefore, and in that case, what are the sort of conditions that you would generally see in place or expect to see in place for there to be, potentially, if there is going to be one, a major low in the equity market? Is it that we need to see more of a recession, more unemployment? What things would drive a real low, a real move, a real recessionary type, I guess, low in the equity market?
Yeah, I mean, you need a proper demand destruction and collapse in demand. I mean, so far what we've seen is a valuation de-rating through higher bond yields, which brings down the multiples, like P multiples or price-to-book multiples. The next step of the sequencing towards a slowdown or recession or a significant fall in equities is really earnings. And for now, you have two things that are preventing this adjustment to be as brutal as it has been in the past. So number one, you have significant cumulative excess savings. In the US, it's roughly $2.5 trillion, so roughly 10% of GDP, which is some of the consequences or benefit of the significant fiscal and monetary stimulus after COVID. So that's roughly $25 trillion globally. And in Europe, you have roughly 7% of GDP in cumulative excess savings. So that's roughly 900 billion euros in sort of, household bank account. So you need a lot of tightening by central banks and this cost of living crisis to eat into these savings and lead into significant demand destruction. So it's a bit like we are in a crash in slow motion, if you will, because of these two forces offsetting each other. But as time goes by and the pressure increases and sort of spending on consumer discretionary start to drop, then you should start to see profit warnings, like some of the auto names we've seen last week. And that ultimately will bring into, will trigger an earnings recession and more dramatic adjustment in equity prices.
And one of the things that people have talked about in this so far is that we've had a slowdown, if we're looking more just the US, but we've had this slowdown, but we've not really seen a change in unemployment. In fact, when we look at the employment data, even if we assume that there is a bit of lagging and there might be revisions, it's still incredibly tight. Initial jobless claims have only just started ticking up. Unemployment is still towards historical lows. And often it's unemployment, which is an indication of a true recession, which is an indication of the sort of redemption type activity that would occur in a true low in the market. But so far, it hasn't really moved. What sort of things could change that? Or what do you see as the reason why we've had such a resilient employment market? And what would be the catalyst for that to run over?
Well, this is an excellent point, Roger, and I think it's clearly a consequence of COVID. It was called the Great Resignation. So if you look at the labor market, there has been millions of jobs that have disappeared. And as a result, we have not only a supply-demand distortion or imbalance in the goods and services industry because of supply chain disruptions, etc. There is a significant imbalance in the job market as well. And as a result, you essentially have two job vacancies for every unemployed in the US. The ratio is roughly 1-to-1 in the UK, for example, and that's some of the consequences of Brexit. And in the US, you also have a drop in immigration. So if the supply of labor drops, and the demand is pretty strong because of all the stimulus that was injected in the economy, creating a surge in demand, essentially from goods to services as people moved out of lockdown. This creates a tight labor market, and the consequences are wage inflation, which is something we're seeing quite aggressive in the US, and this is why core inflation is now more sustained. It's sort of reaching escape velocity, if you will, while headline inflation has been rolling over because the oil prices is down 20-30% from its peak. You have industrial commodities down 20-30% year to date because of the Chinese zero COVID policies, etc. So what we need is essentially higher rates for longer, lower profit margins, unemployment to start picking up, and last but not least, and this is where it gets quite complicated, is that governments are also being tempted to increase fiscal policies to protect lower income households from the cost of living crisis, which makes the job of central banks even more complicated. So ultimately, we might have to reach a level of interest rates that is going to be higher than what it would otherwise have been.
So it sounds like there is this. I mean, when we're talking about the catalyst, because it sounds like it's the employment story that needs to change dramatically, i.e. worsen dramatically. But it sounds like from what you're saying is that the sort of commodity inflation has sort of ended, or at least is now on the back foot. But it's wage inflation that's the concern. That takes a long time to kind of work through, because all the wage negotiations are only just starting in the US. They're kind of coming through now. But it sounds like, is that going to be the catalyst, is that wages eventually start going up, which means either margins compress or corporates start letting go workers. And that's where you start to get the unemployment picking up. Is that the sort of thing that we need to see in order for the unemployment scenario to deteriorate to the sort of level we normally see when you get lows in the equity market?
Yes, absolutely. But I think it's a bit like the physics. In physics, you have Newton's third law of motion. So behind every action, there's a similar reaction and opposite reaction. So as you see labor cost increase, which is roughly 2/3 of the input cost for companies in the service industry, which is the majority of, the most abundant sectors in developed countries. It will depend on the ability of these companies to pass these higher input costs. And if demand starts to fall, then this ability gets diminished, and then profit margin gets hit. And over time, if demand slows down enough, then they'll have to reduce their labor force. But what's interesting is two things. Number one, it takes 3 to 4 quarters for every rate hike to have an impact on the economy. So it means that the interest rate mechanism has a sort of a slow process to impact the economy, particularly now that corporate balance sheets are relatively healthy. They're not over-levered if you look at large cap as they were in the previous crisis. Consumer balance sheets are healthier than what they were in the subprime crisis, for example. So you'll need, again, higher rates for longer for its effect to start to bite. And I think ultimately, the central banks are no longer providing protection or puts to the market. They're effectively no longer the friend of risk assets, and their job is to do whatever it takes to sort of cure this inflation virus from the system, and that will essentially mean lower highs and lower lows in equity prices going forward.
So, kind of interestingly, in terms of that, I guess the all-important thing for investors is the timing and the sequencing, because we're all impatient. You can feel it now. Everyone wants the lows to come right here, right now. But it sounds like this is going to take quite a while to play out. I mean, it sounds like we're talking 2023 at the earliest, and maybe longer, because, as you say, 2 to 3 quarters for interest rates to work through. Presumably, a couple more quarters maybe for corporates to really kind of change their employment outlook and employment situation. So, in terms of me as an investor thinking, are you sort of, sounds like the real lows in the equity market are probably still some way ahead of us yet?
Yes, absolutely. I mean, you see that when the equity markets or investors thought that the Fed would pivot, as they did in 2018, in the middle of 2023, that was the July-August rally. You saw the S&P rally by almost 20%. And just for the central banks to sort of, and Chairman Jay Powell to reiterate the message that we're nowhere near done when it comes to fighting inflation, and then the rally literally disappeared over the following few weeks. And I think we'll have this sort of cognitive dissonance between the time of markets in their ability to discount future events and the time it takes for the underlying economy to recover. I was making a joke with a friend saying that it's as if you look at the past few months, the equity market priced a recession and a recovery before the global economy had time to go in a recession in the first place. So that creates volatility and uncertainty. And I think the conclusion here, in the same way as there was this adage that said you should not fight central bank in their ability to fight deflationary forces. Similarly, you shouldn't fight central banks in their sort of conviction and commitment to fight high inflation. And the positive news, however, is we need to monitor core inflation. So when we see signs of sort of continued and sustained drop in core inflation, then it will signal to the market that central banks will be close to their pivot. And that will probably be Q3, Q4 of next year, hopefully. I mean, obviously things can change. And then I think the equity market will start to recover and find a bottom.
So just to finalise here then, in terms of thinking about this, it sounds like because it'll take a long time, rather than the sort of what we're used to in 2018 and then the exogenous shock of 2020 when everything correlated to one in a short space of time and bounced, this will be, as you say, a slow motion car crash, but presumably in that there will be lots of rotation. So it won't just be all equities down, it'll be some down but others up, and there'll be lots of trading opportunities as it'll be 3 steps down, 2 steps up over this extended period. So it actually will be, for the opportunistic outlook, quite a lot of ways to potentially profit from this type of environment.
Yes, it will be clearly a trading environment. So, sectors like, stocks that benefit from the green transition, where you'll see a significant amount of capex, will essentially be more resilient than the overall market. So think about the European Green Deal, Repower EU, or the Biden plan, and think about the sectors that will see all that fiscal stimulus and demand. So this is money that these companies will monetize. And on at the other end of the spectrum, if you look at retail exposed sectors, they're already down 30 to 35%. And some of them, particularly if they have leveraged balance sheet, will have an issue refinancing these debts. And that's where you could see more default on the high yield, and equities will take a pretty significant hit. That being said, I think there's a quote that says there's always light at the end of the tunnel, but just make sure it's not an oncoming train. And in that context, having tactical and trading positions and essentially being agile in the way you look at your portfolio is going to be very important over the next few months.
Well, brilliant. That's very clear. Thank you very much, Kokou, for that. And because it's going to be taking a while to play out, it'd be great to get you back on over this sort of 12 to 18 month period as this unravels, to see where we are and what signposts we can be looking at.
Thank you very much for your time. Thank you, Roger.
As you can see from what Kokou said, we may not see an imminent collapse, but we may more likely see one when a recession and unemployment collide together. But that may not be for 2 or 3 quarters yet. Thanks for watching.